Welcome to the Financial Independence and Retirement Planning webinar. I'm Randy Watzek from Raymond James. Today, we'll talk about a number of key topics that are essential for retirement planning and financial independence. And that's starting with building a strong foundation, the phases of building wealth, the risk of running out of money in retirement, how to fund financial independence, estimate living expenses, and how much you need to retire or be financially independent, and how to manage risk. For a quick background on myself, I have 25 years of money management experience, both on the credit and equity side, and also on the institutional and the wealth management side. And I currently run an investment advisory practice at Raymond James. So starting off with building a strong foundation, this is more important than investment allocation or choosing the right investments or trying to get an extra % return or whatever in the beginning. Because if you think about it, if you're starting with $1,000 and you get an extra %, it won't add up to very much. But if you can save an extra $10,000, that makes the difference. So in the beginning, that's far more important. Spending less than you earn, building an emergency fund, getting rid of unproductive debt, improving your earnings capacity, and saving consistently for retirement over the long term. And this is also pretty important, especially people in their 20s starting out, to try to cultivate a prudent and patient mindset. A lot of people look for the big score, the quick returns, but what really builds wealth over time is consistency. And this is just an example of it. If you take someone who's starting out with $500 a month, then almost anybody can save $500 a month, even at a lower income level. If you can just do that consistently from your 20s to your 60s, 40-year period, and you don't even need a great return, a 5% return, you can build $763,000 of retirement savings by the time you're ready. And that's more than the vast majority of people that are in America do. So it's just that consistency that will do it over time. If you're able to save that $763,000 at a reasonable dividend yield, you could add on another $23,000 of dividend income on top of your Social Security. And then if you're a little more aggressive, stocks have done 8 to 10% over 30-year periods. So I'm using an 8% return here. If you can get an 8% return off of just $500 a month of savings, you could have $1.7 million after 40 years. So it's that consistency, the discipline, patient, and prudent mindset that makes the difference over time. People who look for sort of a quick score tend to blow up at some point. So they might get a big return in 1 year, but then lose it all the next year. So this is just the step-by-step method that's the more important thing. And so if you do manage to accumulate the 1.7 million in savings over time, that translates into over 50,000 a year of dividend income. And then on top of that, you have Social Security. Now, the same logic applies no matter what your income level is. So most professionals can probably save $2,000 a month consistently if they made an effort to that. And you see, if you can do that over 40 years, that translates into $3 million of retirement wealth. And if you get an 8% return, that translates into almost $7 million. So that's more than the vast majority of people are able to do, but it just goes to show how important the consistency is. And I realize that life gets in the way a lot of the time. People make plans and things happen, but that the foundation is the strongest part of planning for this. And then some people, if they're lucky, they're very high income, they're partners at a firm or doctors, lawyers, very successful. I've seen people that can save $10,000 a month consistently, and at that level, they can get into the ultra wealthy category over time. But that's not at all necessary. Again, even going back to the $500 a month level, almost anybody can do this with the right amount of discipline. So, talking about that, the 3 phases of building wealth, we mentioned the accumulation phase a little bit. After that, there's the transition phase, and then there's actually in retirement or financial independence. The accumulation strategy, that's for people who are more than 5 to 10 years away from retirement. The focus is on growth, maximizing savings, and this phase will be in the 20s to the 40s for most people. So some of the milestones to think about in the accumulation phase: in your 20s, you want to be starting your 401ks and IRAs, take advantage of employer matching, building up your emergency funds, avoiding credit card debt, paying down student loans. As you get into your 30s, it's harder for a lot of people because you get married, you have kids, you want to buy a new house, etc. So that's when you're sort of squeezed. Maybe you're taking care of elderly parents or whatnot. But as much as possible, try to put away at least 10% of your income towards long-term wealth building. Then in your 40s, you start to hit your peak earnings years for most people. Your expenses are still high, taking care of kids and parents at the same time a lot of the time, but your earnings are also sort of at the highest level that they'll be during your life. And so you can max out your contributions, sock away some money on top of that, pay for the kids' college savings, and make sure your student loans are paid off. At that point, it might make sense to hire a financial advisor, just because once you're starting to build up enough wealth, then there is a difference that good investment decision making and asset allocation can make. But not everyone needs a financial advisor. Like I was saying before in the beginning, building that foundation is more important. And as you add on annual savings over time, your wealth will increase faster just from the savings than it will in the return. But at some point that flips, and then your return becomes more important to building your wealth than your annual savings. And at that point, it might make sense to consider it. But not everybody does need it, because some people are, they enjoy financial planning, they enjoy researching things as a hobby, and they have the skill and the time to do it. But if you are in that category where you want some advice, I recommend talking to at least 3 different people just to get a variety of perspectives. Everybody's personality is different. Everybody's situation is different. So you want to see who fits best with your needs. And some of the characteristics to look for is someone who will look to listen and understand your situation rather than just pitch some product or some insurance product or investment product or whatnot. You want someone that will actually work with you on your situation. And you also want someone, I would say, at least with 10 to 15 years of experience. You want someone who has experienced a full market cycle, both good and bad. Otherwise, they might take too much risk without having experienced the bad cycle. And then, of course, someone with good credentials. So then moving on, as you get closer to retirement, you're in that transition phase where, say, 5 to 10 years from now, you won't be able to rely on working income anymore. Then you want to think about how you're going to match your assets with income that you need for expenses. So it becomes a little bit less growth oriented, a little bit more oriented towards covering your expenses. But you still need a significant amount of growth at that point, because people are living a long time. A lot of people are living to their 80s, 90s, even over 100. And at that long period, inflation takes a pretty big chunk of your income. So you need growing income to offset that. And so this period for most people will kind of be in their 50s. Some people earlier if they want to retire earlier, and some people later if they love working. For Warren Buffett, it's never, because he's still working in his 90s, but not everybody aspires to that. So some of the milestones in your 50s, income is likely at a plateau. Some people still can generate growing income in their 50s, but most people, their income is as high as it'll ever get. But some of the temporary obligations might be coming down. Their kids might be through college soon, or may already be through college. Mortgages might be paid down if they bought a house in their 20s. So you could potentially have declining expenses. During that period, the amount that you can contribute to retirement plans increases, so you can step up your savings and top off any shortfalls that you have. You also want to begin building safety reserves. When you're in retirement and you don't have income from your work, then you need to be able to rely on having some reserves there, even if the market's bad. And so generally speaking, I recommend having at least 5 years of reserves of your annual living expenses by the time you retire. So in the transition period, you want to start building for that. When you're younger, it's okay to even just have a few months of reserves in your 20s or 30s. But then over time, you want to increase that to a year or 2 years and up to 5 to 10 years. You also want to consider start adding some more income-oriented investments and start thinking about what your ongoing expenses will be in retirement. Your work expenses might go down, but maybe your medical expenses or travel will go up. And then you also want to think about when's the optimal time to start taking Social Security and pension income for you. One thing I would say, though, is to not rely on simple rule of thumbs. A lot of people and a lot of like online software will just use like formulaic types of things like a 60-40 stock bond allocation, 60% stock, 40% bonds, 4% withdrawal rate, or they might have some formula based off of age. And while there's some like general relationship with things like that, rules of thumb that is based off of, everybody's circumstances is quite different. You need to understand where your income is versus the kind of assets that you have, your own risk tolerance, and how much you could tolerate a market downturn, whether you have specific individual expenses like taking care of parents or special needs or whatever. So there's a lot of things that you have to take into consideration. I want to just use, you might use this as a starting point, but I want to use a formulaic approach to figuring out what's best for you. Now, in retirement strategy, that's when you've stopped working or you don't want to rely on work anymore. At that point, it's best to match your income with your expenses. So think about how much investment income your assets can generate, and if that can cover the gap from Social Security or pensions. And if it's not sufficient, then you have to map out how much principal you can comfortably use without running out of it during your lifetime. And you do have to consider that people live a long time. Nowadays, there's good medical treatment for a lot of things that didn't exist before. So you probably want to plan on at least living to your mid-80s or 90s to be safe, that you won't run out of money and be destitute at some point. So this point for most people is the 60s. Some people take an early retirement in the 50s. So some of the milestones in your 60s, when you do pull the trigger on retirement, you want to have at least 5 years of safety reserves, and that's just so you're not forced to sell things at a fire sale when the market's down. You could, if the market's down, you can sort of maintain your calmness by having the safety reserves and make sure that you can fund all the living expenses that you have. Shift to more income-oriented investments to cover expenses. Maintain somewhat of a growth orientation to have increasing income over time, and consider whether long-term care insurance makes sense for you. And then also think, given your finances, how much you have been able to save up to this point, do you need to make lifestyle adjustments to make sure that your income will last for a lifetime? Once you're in your 70s, you might evaluate where you want to live long-term, whether stay where you are or move to a lower cost location if the income is tight. Evaluate income-oriented investments and safety reserves. Maybe emphasize the income part a little bit more and growth a little bit less, but you still need growth at that point, because you can still have a 20-30 year lifespans from there. So you don't want to end up coming up short later when you need it most. You'll also need to start your required minimum distributions for your IRAs and 401ks, update your estate plans. And then when you're in your 80s and beyond, your time horizon's getting a little bit shorter. So again, you emphasize income more, less risk orientation since you're having a shorter term time horizon. Consider whether you want to leave anything to family or society, how to stay active and healthy, what to do if you start to develop chronic illnesses or dementia, and again, update your estate plans. A lot of people forget to do this. There's people, even they have estate plans that are 30 years old, and things change a lot over time. The trustees or executors can change who you want to have power of attorney changes, beneficiaries change. So these are things you want to update fairly regularly and talk to your attorney about that. So some people will think about moving to a lower cost location. There's always the option of just staying at home where you are, but it depends on the situation. Some people have kids who move to different states, and their family and friends move around, so they have no strong ties to where they are. And also their income might be tight where they are, but there might be other options where their income goes a lot further. So part of it could also be weather. Forbes ranks a lot of these places based off of different things, from their healthcare facilities, taxes, cost of living, climate, etc. So these are just some options, but there's a lot of good options all over the country. And then for some of the more adventurous people, there's even options abroad. With places like that, there's places that have retirement visas where you can live there long term without having to be going in and out on a tourist visa. And it just depends. For certain people, they want a little adventure. If you can lower your costs by half versus the US, then some people, even on Social Security, can have a comfortable retirement. So these are some places ranked attractive by International Living magazine. So talking about the risk of running out of money, the average man will live until about 83, and the average woman will live till about 86. And again, that's an average, so roughly speaking, half will live longer, half will live shorter. And you might have seen general statistics saying that the average lifespan is 78 or something like that, but that's from birth. So if you've made it to 65, you've already you have a longer expected lifespan, because the broader average includes people who die prematurely. Now, for a couple, there's a good chance that at least one of them will live into their 90s. So speaking of that, any individual man has about a 10% chance of making it to 93, and women have about a 10% chance of making it to 95. So that's a pretty long lifespan, and you want to make sure that you have the money to last you through all of that. So as you think about that, mapping out a long retirement, there's different phases that most people go through. First phase being sort of the honeymoon phase, where you just retired and you no longer have your work obligations. Maybe you can check off your bucket list that you always wanted to do, travel all over the place, play golf 8 hours a day, or whatever it is that you want to do, gardening, whatnot. But most people get that out of their system after a while, and then they sort of have to decide what they want to do for, like, on a daily basis for the rest of their life. And that could be staying put if they're happy with where they are and they can afford it and they have family and friends there. Other people want to move somewhere else. That's a sort of big decision you want to make. And then there's mapping out sort of longevity, what you're going to do on a daily basis for the next 20, 30 years. Do you have hobbies developed? Do you want to volunteer for things, do part-time work, or whatever it is that will make you feel happy and fulfilled? And then finally, it's an unfortunate fact of life that usually one person dies before the other in a couple, and so you have to think, if you're the solo survivor, how life is going to look like for you, and whether you'll have a good support system and family and friends and different things to keep you happy and fulfilled while you're living alone. So in terms of funding retirement, the three basic ways of doing it are spending retirement income, drawing down principal, or continuing to work. And on that last point, I would just caution that most people think they're going to work in retirement, but in reality, not many actually do. And there's a variety of reasons for that, ranging from it's just harder to get the kind of job that you're used to as you get older, to being less tolerant of the stresses of work, which you're thinking, well, I don't really need to do this. Why should I do this? And some people have health conditions or whatnot. So I wouldn't really rely on the idea that you'll be able to work indefinitely, but it's a possibility if you're still in good health and you enjoy what you do. In terms of types of retirement income, there's two basic types, and one is lifetime income, which is Social Security, pensions, annuities with a lifetime rider. And then there's also investment income, which can also be lifetime income if you plan it right. That's interest income, dividends, and rental property. So as you look at lifetime income, Social Security is very nice in that it adjusts for inflation over time, but it's just at a fairly small level for what most people want to live a comfortable life. Pensions are nice when you have them. Most people don't get pensions nowadays, but there's still some people who do, and it's nice, very nice supplementary income. The one thing about pensions, most of them don't adjust for inflation. And so you might start out comfortably with pension income and Social Security, but over time, as inflation bites away at your dollar, then it won't be enough in your 70s, 80s, 90s, or whatever. So you still need to make other plans for growing income over time. Annuities with lifetime riders can provide lifetime income, but they also usually don't adjust for inflation. And the payout is usually not that great compared to investment options. So in terms of investment income, interest, the advantage of that is that there's low principal and interest risk if you're buying high quality bonds like treasuries or investment grade corporate bonds. The disadvantage is that they don't yield that much. That has improved recently this year, but it's still not a really high yield enough to live off of, because they don't keep up with inflation. So you have to reinvest a lot of the interest income in more bonds, even just to keep up with inflation over time. With dividends, the pros are that the yields can be attractive, or they could be as high as fixed income, and they might grow faster than inflation because they tend to follow corporate earnings, and earnings tend to increase faster than inflation. The disadvantage, of course, is that companies don't have the obligation to pay dividends. So during a recession, they'll generally cut dividends along with earnings. So for example, during the financial crisis of 2008, 2009, companies cut their dividends by about a third. So you do have to factor in the risk of a recession if you rely on this strategy and having excess reserves. Rental property, the yields are usually pretty attractive on a cash basis, and if it's in a good location, the increase in rent over time can offset inflation. Disadvantages being that you have to deal with vacancies, repairs. They're not very liquid, so if you need the money for something, it's hard to realize it quickly. And then you're concentrating a big portion of your wealth in one property. And so if something happens to that property, it can be tough for you. And also, they just require management. It's not a passive type of investment. You do have to fix things and have calls from tenants when repairs are needed. And a lot of people in their retirement, they just don't want to deal with that kind of stuff. So if you look at long-term returns, inflation over the last 100 years has been about 2.9%. Over the last 20 years, it was better. It was around 2%, but then recently, the last year plus, it's been well above that. So I would sort of expect over time, there might be times when it's less than 3%, times when it's more, but I think 3% is a good average inflation rate to expect. And so treasury bills, generally speaking, have just earned enough to offset inflation. And that's before taxes. So if you have to pay taxes on that, you probably earn less than inflation. Bonds have done a little bit better at 5.7%, but good quality bonds are not yielding that level right now. They used to yield a lot more. If you look back at where they were, like you could easily get that kind of yield in the 90s or before, but they're still kind of low versus historical levels. And then again, you have to pay taxes on that, and so that makes it harder to do better than inflation. The amount that's better than inflation is basically what you can spend if you want your income to adjust for inflation over time. What's done better than that over time is stocks. Of course, stocks have risk during recessions and whatnot, but the average return over the last 100 years even including all the big bear markets and recessions, it's been about 10%. And if you look over 30-year cycles, which is what the typical retirement period is, it's ranged somewhere between 8 and 10%. So those are good long-term investments, but of course, you can't rely just on that because if the market is down 50% as it was during the financial crisis or dot-com crash, then you don't want to have to pull out a lot of money when prices are at fire sale levels. So usually some balance is the right approach, balancing funding your expenses for the next several years, the next 5 to 10 years versus long-term growth to cover your inflation and rising expenses. So in terms of estimating those expenses, first step is to come up with a reasonable budget for retirement expenses. Your work-related expenses might go down, but on the other hand, travel expenses, entertainment, medical expenses might go up over time. So there are some people who, again, use a rule of thumb that says retirement expenses will be 80% of your work expenses, but that's not necessarily true. They often don't change. So you have to look at your own individual circumstances to figure out what's going to happen with that. And then you also have to consider that long-term medical and caregiving costs not covered by Medicare tend to rise faster than inflation over time. And so while they might not be huge in your 60s, by the time you're in your 80s, those can take a pretty big chunk out of your budget. So thinking about the different types of costs that you want to plan for, you have sort of the ongoing monthly costs that most people think about: the food, utilities, rent, insurance, medical, transportation, etc. There's some costs that will end, like if you paid off your mortgage, you paid off your kids' college tuition or whatever. Those types of costs can go away, and so then you're in a stronger shape. There's also irregular costs that people often forget to plan for, and that would be things like replacing the roof or boiler in your home, buying a new car every 7-10 years or whatever, taking a big vacation once in a while. And then there's also like contingent or possible costs that can be very expensive but won't necessarily happen, but just depends on your own situation, like long-term care, catastrophic illnesses or an accident, lawsuit or whatever. So those are things to keep in the back of your mind. Consider insurance for, consider extra savings for like catastrophic expenses. So in terms of medical expenses, most retirees will face rising medical expenses. That starts out at about $12,000 a year. At 65, that's not covered by Medicare. And then that goes up to about $39,000 a year by the time you're 85. And so healthcare costs, generally speaking, rise faster than inflation. That's partly because prices are increasing, but also just because you need more medical care as you get older, generally speaking. Not everybody, some people are really healthy and strong at 85 or 90, but generally speaking, in terms of averages, you'll have to spend more on healthcare. And then if you need a nursing home care or memory care or something like that, if you want to be at a good place, it generally costs more than $10,000 a month. And if you don't have the money, then you sort of have to go to a Medicaid place, and those places are usually not very good. There might be some good options out there, but for most people, they're not that great. So if you add all that together, most couples will end up spending about $295,000 on medical costs by the time they're in their 80s. That's not covered by Medicare. So other considerations as you're planning retirement: will you have a paid off mortgage? Are you open to moving to a lower cost location? Do you have long-term care insurance in place, or do you want to have long-term care insurance in place? Are you going to need to help support your children and grandchildren, like both just in general because you want to support them, or maybe there's a special need or some special situation where you kind of have to support them? Do you want to pay for your children's or grandchildren's college education? Those are all factors when you're thinking about how much you need for financial independence. So the ideal scenario is your Social Security, your pension, and your investment income provides enough income to support all your expenses, plus cover inflation over a 30 to 40 year retirement. So in figuring that out, like we were talking about before, you start with your ongoing expenses, then you look at your Social Security and your pension income, and then you look at what's the gap, how much of your expenses is not covered by Social Security and pension. And that gap is the amount that you want to be sure that you can cover with investment income. So, for example, if you're going to be 50,000 short, say you have a pension and Social Security of 50,000 and expenses of 100,000, you're 50,000 short. Well, to cover that 50,000 with investments at a 3% dividend yield, then you need about 1.7 million to cover that. And if you remember going all the way back to the beginning, even somebody just contributing 500 a month for 40 years, getting an 8% return by investing in stocks can actually hit about that 1.7 million number. So you don't necessarily need heroic savings, you just need a lot of consistency over time. But I assume most people at this point have all that ship has sailed, so to speak. So you want to plan based off of the resources that you currently have. So the adequate scenario there is, say you do that analysis and your investment income using relatively conservative safe assets is not going to be enough. You don't want to stretch for income to, like, say, do very risky high yield junk bonds or whatever, oil partnerships or things like that, because those things can lose a lot of money over time and take a big chunk out of your wealth. So you never want to stretch the risk spectrum to do this. You want to see what you can cover based off of reasonable, conservative, safe investments. And so if your income is not covering that, then you need to plan how much can you safely take down in principal so that you won't run out of money by, say, your 90s, or it depends on your own health situation. If you're in bad health, you might want to use a shorter time horizon. If you're in great health, maybe use a longer time horizon. But you want to make sure that even with inflation and whatever, you have enough principal that you can use. Then what I call the soup kitchen scenario is unfortunate, but it's a lot of people end up in this, unfortunately, and that's where you don't have a good pension. You just have Social Security and a little bit of savings, maybe not very much savings, and then you're sort of forced to live off of Social Security, and then you sort of have to cut back on the quality of your life in order to keep living at that level. And about 40% of retirees rely primarily on Social Security for their retirement income. So common retirement goals are funding living expenses, maintaining a good quality of life, living standards for your whole lifetime, covering long-term medical and caregiving expenses, travel, and helping kids and grandkids. The key risk to that, of course, with a long lifespan is rising inflation, catastrophic illness, chronic illness, and running out of money. And just to illustrate the inflation issue a little more, this is the purchasing power of the dollar over the last 100 plus years, starting out the dollar was worth 100, going all the way down here. Or it's been unfortunate, but it's the government's way of taxing people indirectly by printing money and causing prices to rise. And so again, I would plan for it to be conservative. I plan for at least a 3% inflation rate when you figure out your expenses over time. So a solid financial independence and retirement plan will map out all the available resources and income options while managing the risks to your quality of life. And this is important because wealthy people tend to live longer because they can afford better medical care, better, like, healthier lifestyles, things like that. Wealthiest men live about 15 years longer than the average man lives, and then the wealthiest US women live about 10 years longer than the average woman lives. So if you need professional financial assistance, a good financial advisor or planner can help you figure out how long your money will last. And that's basically what I do. I always start out with financial planning, figuring out everyone's unique circumstances, and then thinking about the best investment strategies to help them meet their goals.